Index funds are a cheap and simple way for nearly anyone to passively invest into hundreds and even thousands of companies all within one purchase. And with their rise in popularity, they have just recently passed actively managed funds in the total amount owned for the first time in history. Which, not to mention, but the first index was created in 1884 by Charles Dow that was originally known as the Dow Jones Railroad Average that consisted of 11 stocks. But it wasn't until almost a century later in 1976 when Vanguard created the first index fund that tracked the S&P 500, giving individual investors like you and I the ability to easily gain broad exposure to the US stock market. But with all the credibility that the S&P 500 has earned, also being referred to as the US stock market benchmark, a surprising fact you probably didn't know is that since 1972, small and mid-cap indexes have actually outperformed the S&P 500. I'll touch on that more later in the video, but needless to say, there is a ton of history behind index funds, and it's exactly why I'm going to explain the major turning points they've had over the years, shocking facts you probably wouldn't expect, and where the potential index fund industry is headed based on current trends. Knowing that, my name is Sully, and all I ask is if you do find value in this content, that you consider hitting the like and subscribe button for future content like this. With that said, let's first go over the major turning point for index funds. To start this off, one of the most popular indexes, the Dow Jones, short for the Dow Jones Industrial Average, was first introduced in 1896 and has been regularly quoted in news broadcasts, newspapers, and journals as an indicator of financial markets and economic conditions in the United States. The first calculation of this index was composed of 12 different companies in the industrial sector, where the only one still listed as its own company today is General Electric. And by 1916, the number of stocks rose to 20, and again rose to 30 stocks by 1928, which the Dow Jones still remains to this day to have 30 companies in the index. Now, another popular index that you probably have heard of is the S&P 500, where in 1923, the OG Standard Statistics Company developed its first stock index. This precursor of the S&P 500 tracked 233 US stocks and was calculated weekly. By 1926, it was reformulated as the Composite Stock Index, which tracked 90 stocks and was calculated daily, and over time the number of securities grew and the frequency of calculations increased until in March of 1957, the S&P 500 was officially introduced to the stock market as we see it today, that includes 500 of the largest publicly traded US-based companies. But understand that it was almost an entire century where indexes were primarily used for data and informational purposes. In fact, the Institute of Business and Finance reports that Wells Fargo was the first to use index portfolios for some of their institutional pension plans starting between 1969 to 1971. And it wasn't until 1976 when Vanguard officially introduced their Vanguard 500 Index Mutual Fund that allowed individual investors to actually purchase an index. This gave investors the ability to gain great diversification across the US stock market while having a cheap cost, especially compared to actively managed funds. Not to mention, but it also offered less risk and time spent for investors rather than having to buy numerous stocks on their own. Because of this, much of the 80s and 90s led many analysts to researching topics like the efficient market hypothesis that explains how markets efficiently factor in information provided, implying that trying to beat the market is extremely difficult. So in the early stages, the only way to buy an index fund was as a mutual fund, but with technology advancing in the modern world, launched in the US in 1993, were ETFs, short for exchange traded funds, that revolutionized investing because they offer a blend of flexibility, tax efficiency, and other features. To simplify it, just understand that there are two forms to buying an index fund, so it's either a mutual fund or an ETF, and an example of a mutual fund that tracks the S&P 500 would be through Vanguard with the ticker of VFIAX, where Vanguard's popular ETF version is VOO. Both of these track the same S&P 500 index, but they have slight differences when it comes to their structure. I made an entire video explaining the differences on this topic, and I'll have that linked in the description below as well. But know that ETFs are growing at an incredible rate and have just recently passed mutual funds in cumulative net flows into them. But as a whole, index funds actually took quite some time to initially gain the credibility in the investment world, and it wasn't until the beginning of the 2000s where index investing exploded with significantly more offerings to investors. This growth is also why investors have been steadily moving away from actively managed funds to buying index funds, where they are just starting to pass the halfway mark in market share with no signs of going down. In fact, according to Morningstar, in 2024, the total assets in US passive mutual funds and ETFs narrowly surpassed those in active ones for the first time, the gap between active and passive assets widened even more, and the total amount in passively managed assets grew to over $16 trillion, while actively managed assets stood at just over 14 trillion. Not just that, but passive funds in the US have attracted more inflows than active funds for the past decade. Now, before I go over where things may be headed, let's now go over shocking facts you probably wouldn't expect. As I mentioned, index funds took quite some time to build trust and go mainstream in the investment world, and when Vanguard first invented the index fund, it was ridiculed by many investment professionals as un-American and that it would lead to average or mediocre returns for investors. Yet recent data from the S&P Dow Jones indices shows that over a 10-year record of actively managed funds, when compared to their underlying index, only 18% beat large cap funds, only 12% beat small cap funds, and 16% beat international index funds. And not just that, but the longer the time horizon, the more likely actively managed funds are to underperform their underlying index. And to add to the credibility of index funds, the legendary investor Warren Buffett won a $1 million bet against the hedge fund industry, stating that the S&P 500 would outperform a basket of hedge funds over a 10-year period. And crazy enough, no hedge fund beat the S&P 500, and the average wasn't even close. Not to mention, but Charles Schwab states the cost of their average index fund annually is 0.05%, where the average actively managed fund is 0.76%. While the difference may not seem significant, throughout the course of your entire career, that could save nearly anyone watching this hundreds of thousands of dollars. Let's just say you have $1 today and start investing $500 per month, getting the average stock market return with the average index fund at 0.05% of an expense. After your entire career, the total cost from fees would be $35,000, resulting in an end portfolio of $2.6 million. And besides the fact that actively managed funds barely outperform a broad stock market index fund over the long term, with the same example but now averaging a 0.76% expense ratio throughout your entire career, that would result in a total cost of $493,000 with a total end value of $2.1 million, which is a $450,000 difference. Needless to say, index funds have proven over and over to be among the best options for nearly anyone looking to invest into the stock market over time. It's also a big reason why Warren Buffett says if you invest in a very low-cost index fund where you don't put in the money all at one time, but average in over 10 years, you'll do better than 90% of people who start investing at the same time. But one fact that may greatly surprise you is that small and mid-cap index funds, which are ones that track small and mid-sized companies, they have actually proven with data going all the way back to 1972 that they have outperformed large cap stocks. As you can see, the mid-cap index is actually at the top with an 11.8% annual return, then small cap at 11.37%, and then large cap at 10.81%. Sounds minimal, but a starting amount of $10,000 in a US large cap index would by today now be worth $2.4 million. If it were small cap, it would now be 3.2, or mid cap would now be $3.9 million, which provides an extra $1.5 million from the large cap index because of averaging 1% higher of an annual return. Additional research I found by Paul Merriman also shows that the percentage of time a particular asset class performed the best of all major indexes was for small cap value, with the odds increasing more and more the longer of a time horizon. But understand that historical returns by no means indicate future results, because if we look over the past 20 years, large cap stocks have actually outperformed, averaging just over 10% per year, mid cap at 9.5%, and small cap just under 9%. Now, I personally have the majority of my investment portfolio in large cap stocks through broad index funds, but I find this really important to know because I believe diversification is crucial to reducing risk and aiming for optimal returns over time. Because of proven data, index funds have gained significant traction, where Vanguard to this day still leads the way for index funds, as their total stock market mutual fund, VT Sachs, has $1.8 trillion in assets, with their S&P 500 mutual fund being 1.3 trillion, and they also have the largest ETF in the market, that is VOO, with $700 million in total assets. Because of this, let's now go over the future of index funds. Although this massive growth has been great for individual investors to easily gain diversification at a low cost, before Bogle passed away in 2019, he sounded a warning on index funds, saying it's only a matter of time before they own half of all US stocks, which he did not believe that such concentration would serve the national interest. As of 2018, 3 index fund managers known as the Big Three dominate the field with a collective 81% share of all index fund assets, with Vanguard at the top having a 51% share, BlackRock at 21%, and State Street Global at 9%. This dominance is controlled by the top companies because the indexing industry is extremely difficult for new entrants to compete, which is because asset management is a business of scale. The more money a firm manages, the more it can lower fees, making it difficult for new companies to enter, and is why Vanguard offers some of the lowest fees and best overall index fund options available in the market. But if historical trends continue, a handful of giant institutional investors will one day hold voting control of virtually every large US corporation. The Big Three now control over 20% of the votes on the S&P 500, which means that control of most public companies will soon be concentrated in the hands of the dozen or fewer people who manage the top investment firms. So the few people, rather than individual investors, will essentially decide what corporate policies should be. Already, the Big Three represent the key votes on matters such as mergers and shareholder campaigns, and as a result, these firms have unprecedented power in the market as they act on behalf of their client shareholder voting rights, and others worry they will be too willing to use their influence to pursue political goals rather than maximize shareholder value and ensure effective governance, which they could swing the outcome of important matters such as mergers, major investment decisions, CEO succession, and director elections, making the Big Three potentially the most powerful force over corporate America. But because index funds are so beneficial for individual investors and are a great tool to boost the economy, banning them's out of the question, but keeping an eye on the top company standards is going to be crucial going forward. Now, if you found value in this content, I'm going to leave other videos and resources I created that I think you may find great value from, linked in the description of this video. And don't forget, if you want to get started on a new investing platform or even a high yield savings account to earn more interest on your cash, I'll also have a direct link below to some of my favorite ones as well, which depending on the ones you get started with, I may earn a commission for it, which is greatly appreciated. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.